Recently, Nasdaq Composite Index has fallen into bear territory. In the bear market, the stocks tend to go lower and lower, and the game plan can be totally different from the bull market. In this video, I will be focusing how I use moving average to assist my investment journey in the bear market. I will make sure this part of moving average video is more unique. Please note that I only have one experience in the bear market in my investment journey. So, my strategy is for your reference only, and hope that I still manage to provide some insight to you. By the way, if you need a refresher on moving average or have not watched my previous video on moving average yet, you may watch the video here to refresh the fundamental of moving average. I will break this video into 3 parts. How to defend ourselves in bear market with moving average, which moving average to use to add more shares in bear market, slope of the moving average, how I take my profit from my oil stocks before it crashed. First, how to defend ourselves in bear market with moving average. Let me quickly go through the typical behavior of bull and bear market again. In bull market, moving averages are sweeping upward. Stocks are moving higher high and higher low. Each dip is an opportunity to add more shares. Buying at each dip can make us more money. However, in a bear market, everything is opposite. Now, the moving averages are sweeping downward. Stocks are moving lower high and lower low. But where to add the share? Wherever we add the shares, either at the high or the dip, it seems that we will lose money. Thus, in the bear market, we need to focus more on protection instead of just buy the dip that could finally hurt our psychology in the stock market. In general, stocks move in a similar direction with index. Thus, in the bear market, I will focus more on the moving average of the index. I will talk more about each moving average and period in the latter part. For example, when Nasdaq Composite Index is moving out, most of the technology stocks are moving up too. You may ask, since the individual stock and index are moving in the same direction, what is the difference? The answer is beta. Each individual stock has its own beta. For example, by using FinWith, Apple has a beta of 1.2. In general, beta is a measure of a stock's volatility in relation to the overall market. Overall, the market itself or index, such as the S&P 500 index, has a beta of 1. A stock that swings more than the market over time has a beta above 1, which brings more return or higher risk. In contrast, if a stock moves less than the market, the stock's beta is lesser than 1, which brings lesser return or lower risk. Back to the Apple. A beta of 1.2 means apples tend to move 20% more than the index overall. Let's recall on what I mentioned previously. In a bear market, the stocks tends to move lower and lower, and we do not know where the bottom is. While a high beta stock has a potential to bring us more profit in the bull market, in the bear market, it has higher chance to lose us more money when the stock is moving lower and lower. Thus, whenever we want to add individual stocks in the bear market, it will be always good to refer to the index chart first. Part 2. Which moving average to use to add more shares in bear market? Okay, now we know that index should be the priority to analyze during the bear market to reduce our risk. For example, below is the Nasdaq Composite Index daily chart. By using the moving averages alone, we can identify the following characteristics. Price is below SMA 200 red line, SMA 50 blue line, and SMA 100 orange line are swooping down. lower high and lower low. Now, EMA 20 pink line acts as a resistance and the price moves lower whenever touches it. The above four characteristics show that the Nasdaq Composite Index is in a downtrend, a typical characteristic in the bear market. However, let us change the chart to weekly chart. What do you see now? It is still in an uptrend if you look the chart at a longer time perspective. Price is above SMA 150, green line, or SMA 200. SMA 50 and SMA 100 are sloping out, higher high and higher low. Now, it is pretty clear to know where to add shares, right? We can add the shares in the weekly support as long as it is still uptrend. Interestingly, the last COVID crash rebound at SMA 200, while SMA 150 served as a good support for 2016 China market turbulence sell-off and 2018 to 19 trade war sell-off. Of course, even weekly chart won't be able to hold for huge sell-off such as subprime crisis in year 2009 and dot-com bubbles burst in year 2000. Nonetheless, weekly chart is still useful to help us to filter out a lot of noises in bear market, especially when we are using a daily chart. Part 3. Slope and Parabolic. This is an additional part of the video. Recently, the crude oil price surged like crazy to as high as $113. Instead of chasing and buy more energy stocks, I put my trail stops on all my energy stocks such as XLB and SLB and sold them. Why? If we look on the chart carefully, the slope of the price movement already changed. It became parabolic move, where the price movement is no longer as gentle or near to the key moving average as previous price movement. When the parabolic move happens, the price is very far from the moving average, and this is a warning signal to me. Indeed, I share this in my Telegram group, and indeed, it fell to hold and fall back to the key moving average again. Now, many people who chase the oil stocks were trapped at the high. This will become a natural resistance to the price movement as they will prefer to get rid of the stocks whenever it moves back to their entry price. Another example is ARKK. Can you spot where the stock price moved parabolic and deviated far from the moving average? Then we could see what happened later. Okay, that's all I would like to share in this video. Thank you very much and see you in the next video.